March 21st, year 2024. The time is about 6:10 p.m. This is Mijanur Rahman. The copyright of this video belongs to me. The content, every aspect of it with respect to copyright belongs to me. This is the T2 return. It is slightly complex than the other one that I published. This particular tax return deals with capital gains, real property purchase, such as building, and dividend income from eligible dividend income from publicly traded corporation, where the owner for this business, Mr. Raj Ali, is not a connected or related person with respect to the dividend that is received or that was received. So before I get to this tax return, I always make sure that I always prepare documents on Excel sheet to make sure that if possible, there is no errors at all. There is no making sure there is no errors. There are no errors and omissions. So as you can see at the bottom of the screen right here, where I'm showing the cursor, or where am I holding the cursor, the e-file is eligible for this return. This T2 return is eligible for e-filing, and the federal taxable income is $812,561. I apologize, $812,561. I am going to take you to the Excel sheet. So this is the scenario. In this scenario, I'm going to make some changes to the previous one. Here I'm going to assume this corporation was incorporated in 2022, January 2nd. So I'm going to change that over here. And everything else remains the same except for the revenue earned from the business and also for the capital gain and dividend that he received. Every other scenarios in his personal life hasn't changed, and the only thing that took place, 3 new transactions in 2023. Now this is, in this video, I'm discussing the second year tax return. I assumed the company previously filed the 2022 return for the year 2022. So this is the snapshot of the Excel document. I just want to show you this so I could move to the PowerPoint. So let's go to the PowerPoint, and then I can come back to the Excel sheet again. So this is the professional corporations. The name of the professional corporation is Raj Ali Law Professional Corporation, and this is his T2 return integrated with his personal T1 tax return as a professional. This is a similar presentation for any other professional who is regulated, except for the real estate agent. The real estate agent is not, unless he's a broker, but I would have taken a look at whether he can incorporate or not. The last time I checked, the broker was able to incorporate. So I would have to take a look into it. So this particular video deals with the eligible dividend, building capital gain, and the income that is not eligible for the SBD, and income that is subject to SBD bold. SBD stands for small business deductions or deduction. So this is the scenario, same thing, nothing changed. This presentation only provides certain guidelines. There are some requirements for adjustments, but that won't be this is only a demonstration. We looked at this in the previous video. This is the remittance. This is the salary payment that he receives from the ABC Law Professional Corporation, where he is working part-time. He doesn't own this corporation. This corporation, Rajali Law Professional Corporation, he owns it, and he receives monthly salary payment from that. And this is his remittance. The Rajali Law Professional Corporation requires to file on behalf of him to the government. This is the revenue and expenses. If you take a look at that, in here, the revenue is higher, 1 million. I could change that to 2 million, 10 million, 100 million, or a trillion. Makes little difference. Again, you remember those alarming red cells and amber cells. Okay, so if the cells are highlighted, you need to pay specific attention to that. I already discussed that in previous video. In this video, I'm presenting this a slightly different way, so you will get to know. You're already familiar with this if you saw my previous video. This portion is the salary for the employee's assistant. This is the portion that the Rajali Law Professional Corporation issues to him, including the remittance that is filed with the government. Remember, this is his professional corporation income. We're talking T2. Okay, that's why you see the line numbers here is different. Okay, and this is the net income before paying salary. This should be after paying salary here. I would have to change that. So I think I made a typo here. It should be net business income after paying salary to Raj Ali. So when I copied down from here, I forgot to change that. It's not big deal. I know you understand it. So this is his taxable income right here. Remember, he had home office, part of his condominium. I'm not going to show you the criteria for writing up the home, internet, and landline. I don't want it to get into an audit. It's not an audit issue, but it's more of a segregation issue. So most likely you make a mistake and use it. So I always try to avoid this. Avoid including this as a deductible expense. And there are other deductions, as you can see here. If you made any charitable donations, then I would deduct it. So after the home office deduction, which is the 3,820, the total business income from the operation for tax purpose is $812 $812,561. This is the income for tax tax purpose prior to some other adjustments. So this would be line 3A, I believe. So if I put 3A, that would be 3A. And this is the taxable capital gain with 50% deductibility or inclusion rate. I think it's 50% exclusion rate, I think. Yeah. The 50% deductibility in the taxable capital gain would be 5,000. So this would be 3B over here. And remember, in this case, I add back the non-deductible portion of the meal portion that I previously showed you in a different way. Now, the total net income for tax purpose is this right here: $822,561. Don't get confused with this, okay? This amount is this for the net income that we use to calculate not the tax, but for tax purpose. Now we need to deduct this. There are deductions here, which is right here. You can see the dividend we receive from the publicly traded corporation where Mr. Rajali is not connected or related person for the tax purpose. Then you have to subtract that because the corporation, Canadian CCPC, the tax rules for the dividend is slightly different. So I'm going to show you that later on. You'd see that. The next thing I would have, if I had net capital loss, then I would put it here. And then net capital loss used in 3B. This is different. Net non-capital loss and net capital loss. I'm going to show that to you later on. What are the difference between them? Okay. So now we want to after deducting this $10,000 from this income for tax purpose, we arrive at the taxable income. The taxable income is $812,561 right here. And this can be found in your T2 line 360 on the T2 form. So this is the taxable income we just calculated over here, $812,561. His general tax rate is 30%. This is the tax. There's the first calculation, the general tax. Now it gets some deductions and additions. It gets an abatement, 10%. This is a deduction. In my previous video, I may have mentioned that to you as a credit. What I mean by that is the deductions. Some of you are not familiar with the deductions. So let's call it a deductions for tax purpose, okay? So this is the deductions which will be deducted from this amount. You see it in very shortly. And this amount, the refundable tax at 10.67%, the lesser of these two. Okay, the lesser of these two. I'll show that to you on an Excel sheet. This amount we need to add. Okay, I'll tell you that in a different video. Why? Okay, you're not a tax student or a tax professional. If you're a tax professional, then you know why. But if you're not a tax person, it would confuse you. Just know that the refundable tax at 10.67% rate, it would be an refundable tax. It's added as an addition to the general tax rate. Then we have different deductions. The deduction for the small business deduction, this is the list of. Now, look out for the specified income. This specified income is that when someone actually provides services to connected corporation, but we don't have this in this case. I just want to point this out so you know. So in this case, the lesser of this, the least of these three. So in this case, the annual deduction limit 500,000 multiplied by 19%, that gives us $95,000. We are not into manufacturing, so we don't have manufacturing deductions. So therefore, this amount is zero. Now, this general rate reduction. Remember, I promised in the previous video that I was going to show you how that works. So the general rate reduction is at 13%. This is a deduction. In this deduction, we have first we get the taxable income, which is this amount right there, 812,000. Then we subtract this. So we put the taxable income top. This is the positive number over here. And the small business deduction of 500,000. If I had MP deduction, the MP doesn't stand for military police or member of parliament. It simply stands for manufacturing. Okay, manufacturing and production, I think. So the aggregated investment income. This is not zero. You'd have to excuse me. I forgot to take that off. This is 5,000. This 5,000 came from the capital gain, right? Okay, so this is the capital, half of that capital gain. Okay, and then we have the income eligible for the general rate reduction. Would be if we add this bucket with this 812,561 minus 500,000 minus 5,000, we'll arrive at this number, $307,561. We just simply multiply this $307,561 with the 13%. That would give us $39,983. What I've done, I simply add these negative numbers over here, the deductions, and put it here as total deductions right there. So that is $216,239. In this bucket over here, this is known as Part 1 tax. You can see it in red block over here. Part 1 tax. Part 1 tax payable would be $93,068. If we add $308,773 plus $534 plus $216,000, or actually minus $216,239. This would give us the tax payable under Part 1 tax, which is the $93,068. Then we go to Part 4 tax. And this Part 4 tax comes from the eligible dividend that received from non-connected corporation or not associated corporation. In this case, it happened to be, I believe, it was from. I'll show that when I go to the profile. You see, it came from a public corporation. It could be Apple or Microsoft, but one of those things. These are the two companies that I used for the capital gain and the dividend purpose. So we just simply take the eligible dividend received, so 38.33%. We just add this number, okay? When a company pays dividend, especially eligible dividend, the receiving company unfortunately has to pay a portion of the eligible dividend received for the tax for that Part 4 tax. However, if this was non-connected corporation, the calculation would be seriously different. If it is ineligible dividend, the calculation would be seriously different. So this is a straightforward calculation. So we have it here. We just simply took 38.33% of the $10,000 that we received. And this is the amount, $3,833. We need to pay this amount to CRA. And then the provincial tax calculation, there are two buckets to that. One is 3.2% for the income up to $500,000, and the remaining $312,000 is subject to 11.5%, the higher amount. I showed that yesterday on a CRA profile, CRA website. If we add this bucket over here, $93,068, $3,833, $51,944, that gives us the total tax payable $148,845. This is the total tax payable for the professional corporation that earned revenue $1 million and had capital gain and had dividend income. Now, this $51,944 is the provincial, the Ontario government receives it. They're very happy, smiling. Wow, so much money coming in just from one guy. Okay. And then we have some major concerns, the major decision that we made. See here, we have a lot of serious amount of retained earning, and I'll show that to you in a second, in a few minutes. We paid taxes, $148,845. We had cash sitting in the corporation. We paid it off immediately, not even a day late. We paid it on the December 31st. When the tax was due, we paid it off. Now keep in mind, some corporations, they are required to make payments quarterly. Okay, I will get into that discussion. We paid dividend to Raj, $48,000. Okay, $48,000 dividend we paid to Raj. We changed it for the first year. The meal expense, the non-deductible portion, we have to add this back. This is very important. We also bought, the reason why I showed that because this would affect the cash flow and also the proceeds from the capital gain. I didn't show this here. And the proceeds from the dividend and income won't affect that much cash flow, but the capital gain, the exclusion portion, which is the $5,000, and the meal expense $5,000, affect our retained earnings and cash flow. Okay, so we also purchased a building solely for the use for the professional law practice. So this building, it's a one-floor building. There's just a few rooms there. The doctor, the lawyer uses for his own practice. He doesn't rent it out. There's no rental income. He also made an investment of this amount, $55,716, and the total assets the corporation now sitting with $675,716. The SPD deduction test is slightly complex than this. I just want to show you a simple way to look at it. If it passes the test, most likely you pass it. But this is a simple way to look at it. Make sure that all assets, at least 90% of the corporation assets, must be used to generate the business income and not investment income. This professional, he practices law, and his revenue source has to be from legal area, not from investment. Any investment income he earns, if it is more than the his his law practice, then he might lose the SPD deduction at all. He might not receive that at all. Okay, so now there are criteria. I won't get into that, but know this. So this is how it was divided. This investment divided with the total asset. So we know it's 1 minus, or you could do 1 minus bracket $55,716 divided by this total asset, $675,116. That will give us 92%. So we are in a safe zone. It's okay. Again, I always say Mr. Raj needs a plan, and he needs a financial plan to reduce his financial risks and business liabilities. He needs a legal plan to protect him and the business. He needs to reduce his tax expenses. He already has. This plan actually somewhat integrated. The presentation integrates some of this planning. So you'll see, I'll show that on the profile, how much tax would have been paid if you didn't address some of those concerns here. This is my contact information. You can always contact me. This is a disclaimer. This is only a demonstration. For your specific situation, please contact me or a professional with the legal, accounting, and investment background who is a professional. So don't just rely on this video. This is only for education purpose. I won't be responsible for any decision errors you make if you try to incorporate any of this concept in your personal life or corporate life. Again, so this is our scenario over here. I'm going to go into full screen mode so you can see better. So this is the revenue right there, and if we go to I could change that over here. This is something I made a mistake here. After paying slightly actually, and I already discussed that in previous videos, so I don't need to go through this. I already showed this over here. This is the summation. You can see that. This is the income for the tax purpose. Okay, and we have this dividend income that we should exclude that from here. And this is our taxable income, $812,561. Again, so you could see here how it's done. Well, it's simply, this is the abatement, and this is the general tax rate at 30%. You can see that right there. And this is this amount over here. We just took the lesser of these two. Okay. And the small business deductions. Again, we had to see over here. This is the active business income. The active business income simply means that the income from the law practice in this case, so the 812,000, the $812,561 minus 15,000, that would give us the $797,561. That would be our active business income. I don't think I made any error there, but I can check it later just in case if I missed anything. The taxable income is already there, $812,561. The SBD limit is 500,000, which is, we know right away it would be the 500,000 multiplied by 19% because this would result in lowest amount of tax deductions for the tax purpose. That's 95,000. And I already told this to you before how it was done on the PowerPoint. Taxable income less this is for the general rate deduction. We first get the taxable income, and then we subtract the small business deduction. Then we go to MP deduction, the manufacturing deduction, and the aggregated investment income. And this would, if we sum this up, that would give us this $307,561. And that would be we multiply this with 13%. You'll see right there, $307,561 multiplied by 13%. That gives us this amount. We add this 3 line over here, 4 line, and we get this over here. Let's see if I could change the color so you can see it better. Okay, maybe. Okay, now you can see better. Okay. Again, we just simply add this up. That gives us the part 1 tax, 93,000 on the screen, $308,773 plus 534 subtract $216,239 would give us $93,068. This is our part 1 tax. Then part 4 tax is that derives from this very straightforward calculation. You just simply take the 38.33% of the dividend receipt, which is $10,000. You'd have to pay this to CRA. $3,833. That is the income you generated. You'd have to pay that tax. And the company that issued, they are subject to the fundable tax credit, but we will not get into that today. So we add this, and then the Ontario tax calculation, the provincial part right there, is 51,500,000 multiplied by 3.2% plus this plus sign over here, plus the 812, let's go to our cell here, $812,561 minus 500,000 times 11.5%. That would give us $51,944, we just simply transfer this over here, this to cell, or this thing, highlighted in green. Okay. We have this bucket over here, part 1, part for tax, that would give us this amount, $148,845. That is the amount that is the tax payable total for the corporation for the T2 return. Now you might ask me, hey, wait a second. This corporation paid tax to Mr. Rajali, not pay tax. The Rajali Corporation, the Rajali Law Professional Corporation paid dividend of $48,000 to him. How come the corporation is not, getting the dividend tax credit? You don't, because that rule is only for CCPC. The CCPC stands for Canadian Controlled Private Corporation. So therefore, any dividend paid to the business owner or the professional who owns the common share of the business in a professional corporation, only the professional can receive common share. Okay, so the common shareholder in a professional corporation doesn't need to, it didn't trigger any dividend tax credit to the corporation, because that's the final disbursement, the final payment. Because remember, when Apple paid dividend to the Rajali Professional Corporation, that dividend hasn't paid out to the end user. It's still within the corporation. It didn't come to the Mr. Rajali as of yet. Therefore, that income is actually, that income is subject to tax to the Rajali Professional Corporation, and that's why, the corporation paid this amount over here. But dividend paid to Mr. Rajali from the Rajali Medical Law Professional Corporation, the Rajali Law Professional Corporation, any dividend it declares or pays to Mr. Rajali, there won't be the corporation don't have to pay any tax, and the corporation wouldn't receive any tax credit from the government. However, Mr. Rajali, the dividend he receives is subject to gross up in his personal T1, and that T1 amount would be gross up. There used to be box 12 in T5. I don't see that on the profile. So you'd have to fill out on a different line. I will get that to you in a few minutes on the profile. Okay, you'd have to manually put it in on the other income section under the dividend. I think it was under the capital gain. Not capital. It was somewhere else. I'll have to take a look at it. But anyway, I'm going to show that to you in a few minutes, so you'd see it where that dividend was. I couldn't put that in T5. There was no box to T5, so I had to put it on the other income. I don't remember the line number at this point on top of my head, so I'll show that to you in a second. I already discussed this over here. The major decisions. If you want to be conservative, you can take the home office expense instead of $3,805. Instead of claiming that, you could claim this, $2,268. This is the reduced charge. It's taxable benefit to Mr. Raj Ali. The vehicle that he used, remember, the vehicle the corporation owns, the total was 50,000 kilometers was driven. See, total driven was 50,000 kilometers, and Mr. Rajali personally drove 10,000 kilometers. if we subtract these two, okay, so it's mostly used for the the business purpose. So if the person is subject to the reduced charge, so you don't need to. I think it's often, depends on the situation. Sometimes you need to take the lesser of these two to calculate the standard charge. Then, in this case, the vehicle was leased, so we used this formula. And, and this is the formula calculation right there. And then we had to find out the reduced standby charge, and this is this amount. This is the amount, and we take half of that. So we take half of that. Okay, so just need to take half of this. So the lesser of this amount, this two over here. So the lesser is the rate is 27 cents into 10,500. The taxable benefits to Mr. Rajal, it would show up in his T4 and under the T1 as other benefits, other taxable benefits. Okay, and this, remember, he also had $2,100 that he paid, that he borrowed personally from his when he started the corporation. I'm assuming that he still have that, that loan due because he didn't retire any common shares. So, and he didn't pay out that loan, I'm assuming. So, not loan, the line of credit. So, in this case, he's probably incurring $2,100 every year in interest expense. So, that interest expense gets deducted on line 22,100. If you click on that line, it will bring up the proper form for you where you could fill that out. Again, it's for the other deductions, it goes there. And then the auto benefit which is the 2,700 amount, that goes to line 12,010 and other income. These are the forms that I used in his personal tax return, same as the other one. I'm going to get into that in a second. And this is his T2 form. So now let's go to the profile, and so this is the info sheet. You already get to know from the previous video. On the information sheet, you could fill out this. All this information is filled out properly, and you have to fill this out correctly, making sure if you don't fill it out correctly, then you won't be able to e-file it. And in fact, the CRA might ask more information. Okay, then we go to the S21 125. In this case, our consulting fee, legal consulting fee, was higher, 1 million. And these are our expenses. And this is the total expenses from the operation. And not every expense is deductible. That's why we need to add back $5,000. You'll see that in a few seconds. This is the net non-farming income, the income from the medicine law professional corporation. $812,561 is the taxable income. And then we go to Schedule 1. This is where it shows how they calculated the net income for tax purpose. You'll see it is $822,561, which is the exact amount we found over here. Right there. The Excel sheet, you can see that. And then I move to the Schedule 3, where we actually, in this case, Schedule 3 is for the dividend received. We actually received the dividend from Apple, and this was $10,000. And this is a non-connected, non-associated corporation. Therefore, a straight rule, we just simply use this 38.13%. This is a tax we need to pay. The Raj only professional corporation need to pay that. And this is I had to sign off on this because the corporation paid dividend to Mr. Raj Ali, not to the other corporation. Okay, and that's about S3. Then I go to S6, Schedule 6. The Schedule 6 for the summary for disposition for the capital property. So in this case, we had some shares from Microsoft. We sold that share, and we had $20,000 share. In this case, remember I told you earlier, this is the second year return for the corporation. So the company invested $20,000 in Apple, not Apple, Microsoft, and they sold the share. And I'm assuming that they got $10,000. This is a fictitious transaction. All data in this is fictitious in this presentation, so they are not from any real transaction. So you don't get any, you don't need to look for information. These are all information that is created, but they're accurate. And the proceed was $20,000. The SCB was adjusted cost base is $10,000. Therefore, total gain is $10,000. This is your taxable, not taxable. This is your capital gain. Half of that is $5,000 is taxable capital gain. Okay, and you can see it right here, right there. Then I go to Schedule 7, the aggregated investment income. And this aggregated investment income, you'll see it here. We fill this out, and this is our aggregated investment income. This aggregated investment income is showing 15,000. I'll have to take a look at that on my calculation. I believe it should be 5,000, not 15,000. So it's 5,000. It didn't make a mistake. It's showing as a total, but you'll see it later on. It's 5,000 once I go to T2. So this is the taxable the again, it's just slightly complex. This is actually the net income for tax purpose right here in line 300. This headline, the highlight here, the The heading is this is the calculation for the taxable income. And we received $10,000 dividend. We deduct that to arrive at the taxable income. Remember, dividend from the eligible, is an eligible dividend. So we'd have to exclude that. Okay. Rather calculate it in a different way. So anyway, so now this is the taxable income right here, $812,561. You could see it at the bottom of the screen as well. The federal taxable amount right there and there as well. Now we calculate the small business deduction. Again, this is not detailed. My calculation is more detailed right here. Okay, this is how I usually calculate. The software looked at it. It showed that that's the lowest amount, so it didn't show any other type over here. And then it shows here I have to see the abatement, so you can see that. So first line is the small business deductions right there. Then you've got your general rate reduction. By the way, the general rate reduction is very complex. You need to calculate GRIP, and I didn't show this in this video, and we don't have any prior balance, so you're okay. But when the company is running, continuously paying dividend, it would and the SBD changes because of the small business deduction, because of the association with other corporation or related and connected corporation, that number could change. Okay, so the GRIP amount, I won't get into the detail, I won't confuse you on this. And again, this is the Part 4 tax right there. The Part 4 tax is 5,000 multiplied by the 30, I apologize, the Part 1 tax, refundable portion of that. I'm not going to show that. I didn't show that on my part. The refundable portion of that. Okay, it works out to be $1,500. I didn't show it on my calculation over there. And then we have I showed the refundable dividend tax on hand. So that needs to pay. Okay, so this amount has to be paid to CRA. I showed you that because I was simply calculating what needs to be paid. And then so over here you could see right there, it's kind of complex over there to the way it's calculated. It's difficult I can hear many people saying that it's difficult for them to understand. But if you go through one by one, when you're on your own, you would see it's not that difficult. It's very simple. But when you calculate the refundable tax on hand from eligible and non-eligible dividend and GRIP and the connected and unconnected corporation, that gets slightly complex, but not so bad. But here I'm going to show you instead over here. So the small business, this is the amount. I showed you this earlier on the Excel sheet right there, $308,773. Okay, so if we add this, line 550 and 604. okay, that would give us $309,306. That is a positive amount that we need to, that is the tax expense. Well, not quite, but the first the addition, and then we get some deductions, which is the small business deduction, $95,000, the abatement, $81,256, and then we have the general rate reduction, $39,983. Total deduction is $216,239. That is our total deductions. And then we have the Part 1 tax payable right there, which is $93,167, which I calculate over here, right there, Part 1 tax. And then we go to Part 4 tax, which I already calculated earlier. This is how it's calculated. I'm not going to go over that again. And then we move on to Schedule 3. I think I showed this to you earlier. This is for the dividend, I believe, that we received. Yeah, this is the dividend. And the Apple was for the Schedule 6 that we actually, for the capital gain. Schedule 7. The Microsoft was for the capital gain purpose. We sold that share, and this is where the capital gain came in the scenario. And Apple, where on the S3, where we actually get dividend income. These are non-connected corporations. There is no issue. This is the balance sheet information. Okay, it's a good idea to prepare cash flow, the financial statements, prior to preparing your taxes, and then this is basically just one line in your financial statements. But this is just a snapshot of the balance sheet. It may not reflect the balance sheet prepared in your financial statements that is based on the IFRS. May not, depending on the situation. And then we have, so this is a prior year. Remember I said earlier that we assume that this is our second year operation. This is the first year operation, prior year in 2022. And we're in this filing is for 2023 tax fiscal year. So you can see the total assets and the shareholders' equity and liability equals the same. Again, you could see that I declared the dividend here, and then the dividend other items affecting the retained earnings with the tax paid. If the corporation is required to pay taxes, then you would have to go over here, line 840. If they're required to pay installments, so you'd have to pay over here, okay, installments. So you'd say $148,845. You'll see this will wipe out this federal balance over here, okay? So you have a refund of $11, okay? Oops, $845, my mistake. And your balance is 0, okay? So this is to show you that. I'm going to close this form. Am I missing anything? This is the T183. You need to fill this out. Oh, I promised that in my old video, previous video, I talked about the the sound wasn't, I took the sound off, but mistakenly. But anyway, in the old video, the previous one, the if the professional was sole proprietor, if he was operating his business in 2022 or prior to that 2021, if he was operating under the sole proprietorship, and if he had any asset like vehicle, buildings, other things he wanted to roll over, then he would choose section 85 rollover, and that would, you'd have to I'll give you an example. Maybe in another video, maybe not now. But I put the form numbers here so you could take a look at that. Section 85 S11. So you could just simply type in here S11, and that would take you to the transaction with shareholders and officers. So let's say we would this is the shareholder and payments, disbursements, loan. So let's say this is something that you need to fill this out. I won't get into that detail because it will affect our balance sheet. So let's not get into that now. Maybe in another video, I'm going to show this to you so that there is no error. But you would have to just keep in mind that there'd be a loan amount and an equity amount. Okay, that equity amount would affect your S100. Okay, so it may not, but it's supposed to. So let's not go into that detail now. Okay, but this is where you go if you were to roll over from proprietorship to the corporation. Okay, if you had to roll over any asset. Okay, while you incorporate it. But in this case, we incorporated first the law professional corporation, so this way we don't have to roll over. Okay. Also, if you're old and you want to do retirement planning, then you can still do it from professional corporation. You'd have to do a strict freeze, which is the section 86 that allows you to defer your taxes. But for medicine professional corporation, there are some specific requirements which has to be met to do that. But if it is a regular corporation, you are free to do almost anything within the spirit of law and the letter of law. Okay. Again, keep in mind this is only a presentation. Do not. Oh, one more thing I wanted to show you. So before I if this person was operating under proprietorship, then he would have to pay $424,819 to the CRA if I didn't perform the planning, if there was no integration, if there was no professional corporation, if there is no financial plan, you would pay $424,819 to CRA. Okay, can you imagine that? Right? But at the same time, at some point, you probably in the corporation you won't trigger that much, but you could plan it and you could reduce your taxes. But some cases you may have to pay out all retained earnings in a professional corporation, not regular corporation. We're talking about professional corporation. You would have to pay out this amount to the common shareholders to keep the SBD amount, a small business deduction, to avoid so that you don't lose this SBD status. Okay, so at some point your tax rate will go up, not the tax rate, but the tax payable, but may not be that significant. Okay, so just be aware of that. Maybe it will catch up after 5, 6, 7 years. But if you have, if you have family members or another doctors or another professional, another lawyers within the family or paralegal, and that changes the scenario. Okay. This is not a legal advice. This video, nothing in this video is providing you the legal investment or tax advice. This is only educational. Okay, so don't implement anything that you learn. Each scenario is different. Each situation is different. There are millions of laws. There are millions of scenarios, and you cannot memorize this. Okay, there is billions of laws. You can't. That's why they educate you, so you could learn, research, analyze, and apply. Okay, but you have to be good at your research. Familiar, that's why you went to accounting. That's why you studied law paralegal. That's why you studied financial planning. So it allows you to, I had to spend nearly 12 to 15 years in school, right? So learning, going through licensing process. So there's a lot of learning. Okay, so that's something that you need to go through. Okay, try not to memorize, rather try to understand. That will help you better, so you can analyze. You can be creative within the a letter of the law. You can apply different law, different rules, different interpretation. And it could, if there's any cases. But at the same time, you need to be fair, legal, and ethical, because tax system it provides revenue to the government. And the same tax revenue is used to develop the country, to provide social benefits and other things. Okay, so make sure that you're fair, legal, and ethical when you're preparing the tax presentation. While you can take the moderate or conservative approach, I recommend, I would personally take that approach rather than the aggressive approach in filing tax return, claiming certain expenses. Just to give you an example, the home office expense, you could choose any item between 2,200 to 3,800 in this scenario. So you could choose that, okay? But you still have to follow the law. Okay, there may be 2-3 amounts for you, so you could elect one of those. Okay, so this is just to show you the personal side of it. If he wasn't incorporated, then this is the tax he would pay. This is the tax that he would need to pay. Now, based on the information that I showed in the PowerPoint, this is the professional T1 return. Here, don't get confused with the one I showed you earlier, where you had the $400,000 tax payable. That is under the sole proprietorship. Remember, what I'm showing you is this is his T1 under the professional structure. Integrated, meaning is that he would receive dividend, combination of dividend and salary from his Raj Ali Law Professional Corporation. He receives this amount, so now he can utilize this, okay, over here. This is the information over here for his T1 tax return, okay? And this is the other income where I showed you remember, this is the dividend received. I want to point this out. There's supposed to be a box on T5 that would show the non-eligible dividend, dividend other than eligible dividends. I don't see that. This amount, the software is supposed to automatically close this up. So it may have. If it didn't, then you'd have to call profile and take a look at the T1, whether it was grossed up. If not, then you have to gross up by this amount. I think it is, I do take a look at that, the gross up amount for the 2023 or 2024. So this number changes frequently, okay, because the tax changes, tax rate. So this number changes as well. So again, you don't need to memorize this. There are a lot of millions of information, but this number changes. These are variables. You need to take a look at that each year. In every file, every tax return you file, most likely different. If it is high net worth, if it is a corporation, okay, our lives are different, our problems are different, our living style is different, our habits are different. So that's what makes things interesting. Okay, and you could call CRA when the publication department interpretation, or it could come. See, I have an advanced accounting background, and also I have a post-graduation paralegal, so I could look up, I could look at a case law. What I've done, I could actually get, I could file something with the court and get a direction where there's a dispute with the certain claims, certain refund return. So I could avoid a penalty. I could in advance. I could get court direction, and I could communicate with CRA and get that resolved ahead of time. But you need to be a paralegal. You need to be a lawyer to do that. Okay, so that's the advantage if you have an accountant who has educational background in advanced accounting, educational background in paralegals, post-graduation, which is different actually. And then um, the advanced financial planning, it is a different. This allows me to analyze certain things in a certain way. Okay. So this is our T4 here. Again, here you can see this is the ABC Lab Professional Corporation where he is part-time employed with another corporation, non-connected and non-associated. And this Rajali Professional Corporation, he owns it. So this is an associated corporation. What I mean by that is he's the this is the shareholders, 100% shareholders, sole shareholder. Not sure. Excuse me. A problem. So my throat is extremely dry. So the this is the auto benefit 2700. It became the other taxable allowance and benefits for him. Okay, and we already went through this. This medical expenses 3% rule. So he incurred $8,100 or $8,100 in medical bill, and the 3% is the deductible. So he can claim $5,465, and that produces tax credit for him. Remember, and don't get confused with the T2. The T2, this is T1. What I'm showing you is T1 now here, okay? That's why it's kind of blue, the screen, okay? So don't get confused with the tax deduction, deductible expense, and tax credit. Okay, it's completely different concepts. There are other deductions, which is the interest income, not interest income, the interest expense. Remember, he borrowed $30,000 from the bank under line of credit loan, and he's paying $2,100 every year in interest expense. He could write that off. Okay, and then this is this climate incentive or carbon rebate. Everybody is eligible for that, and this is RRSP deductions. He had some, this amount came from the 2020 notice of assessment. He had $30,780 to contribute, so we contributed that, and finally we get the balance. Personal life, he pays $1,400. I apologize, $1,024 into CRA. Okay, this is really good. It's much better than 424,000 combined, right? So I hope this helps with respect to the your understanding. If you have any questions, concerns, you can always call me, email me. Make sure that you get advice from the professionals where needed. Don't try to get things done on your own. If you do get stuck, you could always call. Sometimes some lawyers they offer half an hour free consultation paralegal as well. Some accountants, I don't think they do, but I do have an hour offer, half an hour free consultation. So you can talk to me, and any information that you provide to me, I will discard it. If you decide not to hire me, I won't keep anything. I won't disclose your information to anybody else. I'll discard it the moment you decide not to hire me. It's gone, history. Am I missing anything? Oh, I wanted to show you this, the T5 form. See here, they're supposed to be box 12. You see box 11, 10, 14, 18. The box 12 is for the other income, the other dividends, ineligible dividends. See here, if I put this $48,000, that is from the, if in this case, this $48,000, I'm assuming, it's just an example, okay? Don't take it. That's the dividend that I paid to Raja. It's not. I'm just giving an example. The software automatically grows this up. As you can see right here, it's $66,240. So in this case, where I have this 48,000, I'm not sure if it is grossed up or not. It's supposed to be. It looks right there. Looks like it is grossed up, but I need to call profile on this matter to see what seems to be the issue, why the box 12 is not there. This is actually not. This is actually T5. I'm sorry. This is T5 amount came from there. So we'll have to deduct, take this off. Okay. So now you can see this line is gone from there. Okay. Here is my contact information. The copyright of this video belongs to me. You can always contact me. And my consultation, I offer half an hour free consultation with respect to tax preparation and legal consultation. Thank you very much for viewing.